$4,217 per ounce right now. That's not just a number on your screen. That's an alarm bell most will ignore. And if you think this is another bull market, you might be missing the largest capital redistribution in modern history. Here's what experts aren't saying. Central banks are buying gold at unprecedented rates. We're talking approximately 1,000 tons annually for 3 consecutive years. In recent interviews, Jamie Dimon at JP Morgan suggested gold could reach $10,000. Ray Dalio compared owning gold to understanding history. Ken Griffin openly discussed how investors increasingly trust gold over traditional currencies. Think about that. More trust in gold than fiat money. Most completely missed what happened on December 1st. The Federal Reserve ended quantitative tightening. They stopped draining money from the system. And on December 10th, they reportedly cut rates again. This isn't just policy adjustment. This signals a major shift. Because while fighting inflation, the labor market took a serious hit. Approximately 32,000 private sector jobs disappeared in 1 month, the steepest drop in 2.5 years. Small businesses are closing, wages are frozen, consumer spending is collapsing, and the Fed sees it. John Williams, New York Fed president, recently stated they have room to lower rates. My translation? Serious concern. Important disclaimer, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned. This is purely educational analysis based on publicly available information. Let's talk about what gold is actually signaling. This isn't just price movement. This is what I call a trust collapse. Watch this. The dollar index recently fell below 100. That's a psychological cliff. In 1999, the dollar made up approximately 71% of global reserves. Today, around 58%. The dollar is bleeding market share. And where's that money flowing? Gold? Physical gold. Kazakhstan has been buying record amounts. According to reports, Brazil made their first purchase in 4 years. Poland is reportedly targeting 30% gold reserves. 30%. In my view, these aren't just investments. These are strategic hedges. And here's what should really make you think. According to financial analysts, for the first time since 1996, central banks now reportedly hold more value in gold than in U.S. Treasury bonds. More gold than American debt. This isn't just a shift, in my opinion. This is a quiet revolution. Wait, because this exact pattern has played out before. 3 times in modern history, and every time, those who didn't see it coming paid the price. 1933. America's drowning, banks collapsing, approximately 25% unemployment. Franklin Roosevelt does the unthinkable. Executive Order 6102. Gold confiscation. Citizens had to turn it in at approximately $20 per ounce or face serious consequences. Then, once the government controlled it all, they revalued it to $35, roughly 40% devaluation overnight. Citizens lost purchasing power. The government gained control. Gold became the reset tool, and people paid the price. August 15th, 1971. Vietnam is bleeding America's resources. France famously sends a warship. World Gold Council recently released projections. Pay attention. They suggest gold could surge another 15 to 30% in 2026. That would put it between approximately 4,800 and 5,500 conservatively. But they also outlined more extreme scenarios. If geopolitical stress escalates, if yields stay negative, if central banks accelerate buying, some say 6,000. Various analysts suggest 10,000. Others mention 15,000. And some, those who study historical patterns, discuss 38,000, even 138,000. Impossible? Not if you understand the theoretical gold revaluation framework. Here's how it works. Theoretically, the U.S. government officially values gold at around $42.22 per ounce. That's from 1973. Hasn't been updated, but the market currently says 4,200. Now imagine the government hypothetically decides to reset gold's value to back the 36 trillion debt. 36 trillion divided by approximately 8,000 tons of gold equals roughly 138,000 per ounce theoretically. Do they actually have that gold? That's the question some analysts raise. Because the last comprehensive audit of Fort Knox was reportedly in 1953. 72 years ago, the full inventory hasn't been publicly verified since. But if a crisis hypothetically forces a revaluation, and if they need gold to restore confidence, the price could theoretically go anywhere. So what happens next? Here's one likely sequence from my perspective. December 10th, Fed potentially cuts rates 25 basis points. Gold could rally, potentially breaks through 4,250. Momentum could accelerate by early 2026. Gold might test 5,000. If it breaks, there's no telling where momentum stops. But here's the nuance. This cut likely isn't the start of a long easing cycle. It appears to be a tactical adjustment. The Fed is trying to thread a needle, support the labor market without reigniting inflation, but they can't easily do both. Cut too much, inflation returns. Cut too little, unemployment could spike. Either scenario, gold could win. Because in a stagflation environment historically, gold is one of the few assets that can hedge both sides. It hedges inflation. It hedges recession. That's why central banks are reportedly buying. That's why some billionaires are rotating. That's why everyday people are finally paying attention. But here's what mainstream media isn't emphasizing. This isn't just about making profits. This is about preserving what you have. Because if the dollar loses another 20% in purchasing power, your savings lose 20%, your paycheck loses 20%, your retirement loses 20%. Unless you hedged strategically. And the hedge that's worked for 5,000 years is gold. Not stocks alone, not bonds alone, not real estate alone. Gold. Because gold doesn't have counterparty risk. It doesn't depend on a government's promise. It doesn't rely on a company's earnings. It just exists. And in a world where everything feels uncertain, that certainty has value. So here's my perspective. If you're waiting for absolute proof, you might already be late. By the time the reset is obvious to everyone, gold could be 8,000 or 10,000 or beyond your reach. Smart money reportedly isn't waiting. Central banks aren't waiting. Billionaires aren't waiting. So why would you? But here's the hopeful part, because this isn't just doom. This is potential opportunity. Every reset creates winners and losers. In 1933, those positioned in gold were compensated. In 1971, early buyers built wealth. In 2008, hedgers survived the crash. And in 2025, the same pattern could be playing out. But this time, you have the information. You have the historical pattern. You have the warning signs. So the question isn't, will this happen? The question is, what are you going to do about it? Because the Federal Reserve's final warning, in my view, isn't a speech. It's a policy action. They ended quantitative tightening. They're cutting rates. They're signaling the system is fragile. And gold is responding the only way it knows how. By surging. By breaking records. By reflecting the truth. Gold just crossed $4,200. That's not just a price, in my view. That's a signal. The question is, are you listening? If you want to stay ahead and understand what could come next, hit that subscribe button and turn on notifications. Because the world is changing, and those who see it coming will likely be the ones who thrive.